Right at this very moment, there's a silent robbery taking place in your checking account, within your monthly earnings, and through every money choice you're making without understanding how to navigate it properly. These robbers remain unseen because they thrive in that void between what you currently understand and what someone should have taught you years ago. $246 billion annually. That's the staggering amount Americans are hemorrhaging each year simply because of what they haven't learned about managing money. This massive figure represents nothing but pure gaps in knowledge. Bank overdraft charges that were completely preventable, crushing interest rates on debt that should have been restructured, potential investment profits that were never captured, fraudulent schemes that should have been spotted immediately. On average, each American is losing somewhere in the range of $950 to $1,000 every single year, purely due to inadequate financial education. Hi everyone, with you is Julia. Welcome to the channel where I talk about the world of money, investments, and finance in simple terms. So let's get started. Consider what this truly means when you stretch it across an entire lifetime. Losing $1,000 annually throughout 40 years of employment equals $40,000 straight down the drain. However, the actual damage is exponentially more devastating because that same money, if properly invested with even a conservative 8% yearly return, would have grown through compounding into over $270,000 by the time you reach retirement age. We're talking about the difference between continuing to work until you're 70 versus being able to stop at 62. That represents 5 full years of retirement income. That's an entire house down payment vanishing simply because the critical information was never shared with you. The institutions that profit from keeping you uninformed have absolutely no motivation to educate you properly. Credit card corporations make their fortunes when you fail to grasp how compound interest systematically works against your financial well-being. Automobile dealerships maximize their profits when you're unable to accurately calculate the genuine total cost of vehicle ownership. Financial institutions make enormous profits when you park your money in accounts yielding barely a fraction of 1% interest, while simultaneously lending that same money out at rates 20 times higher. The complete financial services ecosystem has been deliberately constructed on the bedrock of your bewilderment and confusion. 87% of Americans report that their high school education left them woefully unprepared for managing real-world financial matters. A mere 19% actually completed a personal finance course before receiving their diploma. Nearly half of all American adults would rate their own financial literacy at a C grade or lower. And perhaps the most condemning statistic of all is that only 48% of adults in the United States meet any objective standard for financial literacy. That percentage has remained virtually stagnant over the past 8 years. 1 out of every 3 American adults frequently experiences significant stress directly related to money concerns. This chronic stress follows you into your workplace environment. It sits across from you at the dinner table every evening. It jolts you awake at 3 o'clock in the morning with anxiety. It erodes and damages your personal relationships. It takes a measurable toll on your physical health. And for the overwhelming majority of people, this suffering is entirely avoidable. The knowledge that would completely eliminate that stress already exists. It's remarkably straightforward. It's readily accessible. It simply hasn't been delivered to people in an effective way. 72% of Americans acknowledge they would have made significantly fewer financial mistakes if personal finance had been taught during their school years. 73% believe they would be substantially further ahead in their financial journey. 71% are confident they would experience considerably less stress surrounding money matters. These statistics represent the collective regrets of millions of individuals looking backward at decades of completely preventable financial errors. This represents everything the educational system failed to teach you about money management. Over the course of the next hour, I'm going to guide you step by step through the comprehensive financial literacy education that absolutely should have been required learning for everyone. Starting from gaining a precise understanding of exactly where you currently stand financially, all the way to establishing automated systems that organically grow your wealth over time. From thoroughly understanding the underlying mechanics of credit scores and debt management, to exploring the psychological factors that drive spending behavior. From building proper emergency funds to opening and managing investment accounts. From purchasing vehicles without getting financially destroyed, to making informed decisions about whether home ownership actually makes sense given your particular situation. This content I'm sharing is purely educational information and should not be construed as personalized financial advice. I am not operating as a certified financial advisor. I don't have access to knowledge about your specific personal circumstances, your income level, your existing debts, your unique goals, or your individual tolerance for financial risk. What I am providing you with is foundational knowledge that empowers you to make truly informed decisions on your own. The conceptual framework that enables you to properly evaluate financial opportunities when they arise. The essential vocabulary that allows you to engage in intelligent, productive conversations with actual qualified financial professionals whenever you need their expertise. By the time you finish watching this content, you will possess a deeper understanding of money management than the vast majority of Americans acquire throughout their entire lifetimes, simply because you made the choice to stay and learn. Because you've recognized that remaining ignorant carries a substantial price tag, and that price compounds relentlessly over time, just like interest does. Let's begin at the absolute beginning with the fundamental question that most people never honestly ask themselves. Where precisely do you stand financially right at this moment? There's a powerful quote that applies perfectly to this situation. If you lack knowledge of where you originated from, then you cannot know where you currently are. And if you don't know your current position, then you cannot possibly know where you're heading in the future. This principle couldn't be more applicable when we're discussing your personal finances. Yet the overwhelming majority of people completely skip this critical step. They maintain a fuzzy, vague impression that their situation is either acceptable or problematic, without ever actually quantifying what acceptable or problematic truly means when expressed in concrete dollars and cents. Before you can make any genuine progress toward financial goals, you absolutely need a crystal clear and brutally honest snapshot of your complete money picture. Your total income, your actual spending patterns, your net worth calculation, and most critically, the gap that exists between them. 3 specific numbers should be permanently stored in your mind at all times. Your net annual income, your total yearly expenses, and your yearly income surplus or deficit calculation. Why focus on a yearly time frame instead of examining things monthly? Because taking a full year view captures absolutely everything that matters. The irregular one-time expenses, the surprising bills that pop up, the insurance premiums you pay on a quarterly basis, the birthday gifts you purchase, the vehicle repairs that inevitably occur, the annual subscription services you completely forget about until they automatically charge your card. A monthly perspective misses these important patterns entirely. A complete yearly view reveals them clearly. Begin by calculating your net income, which means the actual money that lands in your bank account after all taxes and other deductions have been removed. If you receive a regular salary, Simply take your monthly paycheck amount and multiply it by 12. If your income varies from month to month, examine the previous 12 months of actual bank deposits. Include absolutely everything in this calculation: your primary salary, any side hustle earnings, dividend payments, freelance project income, rental property income, interest payments, basically the complete annual amount that flows into your various accounts. Next, analyze your yearly expenses carefully. Use whatever tracking method actually works effectively for you personally. Bank statement reviews, budgeting applications, simple spreadsheets. The specific tool is irrelevant. What genuinely matters is capturing reality accurately. What you genuinely spend, rather than what you imagine or hope you spend. Include all the obvious recurring monthly bills: rent payments or mortgage, utility services, insurance premiums, mobile phone, internet service, streaming subscriptions. Include the less immediately obvious spending categories: grocery shopping, restaurant dining, entertainment expenses, transportation costs, clothing purchases, travel and vacation spending, gifts for others, and make certain to include the expenses you typically forget about entirely. Annual membership fees, regular maintenance costs, those random online purchases that mysteriously add up to hundreds of dollars without you even noticing the accumulation. Now perform the calculation. Subtract your total expenses from your total income. That resulting number reveals everything about your financial situation. If the number is negative, you're operating in an income deficit. You're spending more money than you're actually earning. Every single month, every single year, you're moving backward financially. Deficit spending doesn't merely prevent you from building wealth. It actively and aggressively destroys wealth in real time. It generates new debt continuously. It systematically eliminates your future options. It transforms every unexpected expense into a full-blown financial crisis. If the number is positive, that represents your income surplus, the money remaining after you've funded your current lifestyle. And this particular number is what determines your entire financial future trajectory. Because your income, as important as it certainly is, only purchases your current lifestyle and standard of living. Your surplus is what actually purchases your ultimate freedom. The larger the gap between your income and your expenses, the faster absolutely everything positive happens financially. The faster you can accumulate savings, the faster you can begin investing. The faster you can eliminate outstanding debt. The faster you can build up the financial cushion that empowers you to confidently say no to bad situations and enthusiastically say yes to genuine opportunities. Someone earning $200,000 annually who spends the entire $200,000 annually is absolutely no closer to achieving financial freedom than someone earning $50,000 who only spends $45,000. The high-earning individual might actually be even further from real freedom because their expensive lifestyle creates what people call golden handcuffs. They cannot walk away from a toxic job environment because that job represents the only thing sustaining a lifestyle that's been deliberately designed to consume every single dollar it generates. Now, let's discuss the concept of net worth properly. This represents the ultimate, most accurate measure of where you actually stand financially. Everything you own minus everything you owe to others. Your total assets minus your complete liabilities. Assets are items and accounts that hold tangible value. Savings accounts at banks, investment brokerage accounts, retirement fund accounts, real estate properties, vehicles you own, valuable possessions and collectibles. Add up their current values. What could you realistically sell everything for in today's market? Liabilities represent debts and financial obligations you carry. Outstanding mortgage balances, car loan balances, student loan debt, credit card balances, personal loans from others, medical debt you're carrying. Add up all those numbers as well. The mathematical difference between these two totals is your true net worth. For a significant number of Americans, particularly younger individuals just starting out, this calculated number is actually negative. Their student loan debt exceeds their total assets. That's not a moral failing or personal character flaw. It simply represents a starting point, a baseline. What matters going forward is the direction and trajectory. Is your net worth increasing year after year, or is it decreasing? Are you making forward progress, or are you sliding backward? Tracking this number annually provides you with the clearest possible picture of your genuine financial health over time. It cuts through all the noise and distraction. You might feel wealthy because you drive a nice car, but if that car is financed and you have no savings whatsoever, your net worth tells the real truth. You might feel broke despite having a decent job, but if you've been consistently paying down debt and building retirement savings, your net worth reveals you're actually making solid progress. This number doesn't lie to you. Your feelings about money lie constantly. Your lifestyle can lie persuasively. Net worth is simply mathematics, pure and objective. Once you clearly understand where you stand currently, you can start asking the next critical question. Where do I actually want to go from here? Financial goals provide direction and purpose. Without clearly defined goals, money simply disappears into whatever catches your attention in the moment. With specific goals established, every dollar gains a meaningful job and purpose. Goals need to be concrete and specific, not vague wishes. Not, I want to be wealthy someday, but rather, I want to have $50,000 in my emergency fund within 3 years. Not, I should probably save for retirement eventually, but specifically, I want $1 million in my retirement accounts by age 60. Not, I'd like to buy a house at some point, but rather, I want to save $60,000 for a down payment within the next 5 years. Specific goals can be reverse engineered into actionable steps. If you need $60,000 in 5 years, that's $12,000 annually, which equals $1,000 monthly. Now you know exactly what you need to do. Find $1,000 monthly in your budget, or increase your income to create it. Vague goals just float around, creating anxiety, without ever transforming into action. Divide your goals into distinct timeframes. Short-term goals, achievable within 1 year. Building a small emergency fund, paying off a specific credit card, saving for a planned vacation. Medium-term goals, spanning 1 to 5 years. Building a complete emergency fund, saving a house down payment, paying off your car loan, starting to invest seriously. Long-term goals, 5 years and beyond. Retirement savings, children's college funds, paying off your mortgage entirely, achieving complete financial independence. Having goals across all these time frames ensures you're making progress on multiple fronts simultaneously. You're not sacrificing your present entirely for a distant future, but you're also not living only for today while ignoring tomorrow completely. Now let's talk about the tool that connects your current reality to your future goals, which is budgeting. The word budget carries negative connotations for many people. It sounds restrictive and punishing, like a financial diet that forces deprivation. But a budget isn't about restriction primarily. It's about intention and consciousness. It's a spending plan that ensures your money goes toward what genuinely matters to you, rather than disappearing mysteriously into things you don't even remember purchasing. There are numerous budgeting approaches and systems. I'll cover a few proven methods, and you can choose what resonates with your situation. The 50-30-20 rule provides a simple starting framework. 50% of your after-tax income goes toward needs. These are essentials you absolutely cannot avoid. Housing costs, utilities, groceries, transportation, insurance premiums, minimum debt payments. 30% goes toward wants. These are things that enhance your life but aren't strictly necessary for survival. Dining at restaurants, entertainment, hobbies, travel, shopping for non-essentials. 20% goes towards savings and extra debt payments, emergency fund contributions, retirement account contributions, paying extra on loans beyond the minimums. This framework is simple and clean, but it doesn't work for everyone's situation. If your housing costs alone consume 60% of your income, you can't magically make them fit into 50%. If you're aggressively paying off debt, you might put 40% toward debt and only 10% toward wants temporarily. Use it as a starting point, then adjust to your reality. Zero-based budgeting is more detailed and hands-on. Every single dollar of income gets assigned a specific job before the month even begins. Income minus all assigned expenses and savings should equal 0. You're not spending everything necessarily. You're just deciding in advance where everything goes, including the dollars going into savings. This method requires more active management but provides more control. You know exactly where every dollar is going because you told it where to go. The envelope system, either physical or digital, works well for controlling spending in specific categories. You allocate a set amount for groceries, dining out, entertainment, or whatever categories you struggle with. Once that category's money is gone for the month, you stop spending in that area until next month. In the past, people literally used cash in physical envelopes. Today, you can use budgeting apps that create virtual envelopes. The principle remains identical. Pay yourself first represents a different philosophy entirely. Before you budget for anything else, you automatically transfer money into savings and investments. Whatever's left after that can be spent. This ensures savings happen consistently, regardless of how your spending fluctuates. Many people find this easier than detailed budgeting because it's simpler. Set up automatic transfers on payday, then spend what remains guilt-free. Whichever method you choose, the goal is the same thing. Conscious awareness of where your money goes and intentional decisions about whether that aligns with your priorities and values. The best budget is the one you'll actually follow consistently. If detailed tracking feels overwhelming and causes you to quit entirely, use a simpler method. If loose guidelines lead to overspending, use a more structured approach. This is personal. Make it work for your brain and your life. Now we need to talk about debt, because for millions of Americans, debt is the single largest obstacle standing between them and financial progress. Not all debt is created equal in terms of impact. There's a meaningful distinction between good debt and bad debt, though those terms are somewhat misleading. Better terminology would be useful debt versus harmful debt. Useful debt has potential to increase your net worth over time or generate income. A mortgage on a home that appreciates in value can be useful debt. The asset you purchased with borrowed money increases in value, potentially exceeding the interest cost. Student loans for a degree that significantly increases your earning potential can be useful debt. You're investing in yourself, borrowing at a relatively low rate to access higher lifetime earnings. A business loan that allows you to start or expand the profitable business can be useful debt. You're leveraging borrowed capital to generate returns that exceed the borrowing cost. Harmful debt purchases depreciating assets or finance consumption that provides no lasting value. Credit card debt from everyday purchases, vacations, or lifestyle inflation is harmful debt.
You're paying high interest rates on things that are already gone. An auto loan for an expensive vehicle you can't truly afford is harmful debt. The car depreciates rapidly while you pay interest, putting you underwater immediately. Payday loans or title loans with predatory interest rates are extremely harmful debt. These trap people in cycles of borrowing that become nearly impossible to escape. Even within these categories, context matters significantly. A mortgage is useful debt if the home fits your budget and you plan to stay long enough for appreciation to offset closing costs and interest. It becomes harmful if you're stretching to afford something beyond your means or buying in an unstable market. Student loans are useful if they're for a degree with strong employment prospects and the total debt is reasonable relative to expected earnings. They're harmful if you're borrowing 6 figures for a degree with limited job prospects. The key question is always this: will this debt help me build wealth? Or will it prevent me from building wealth? If the answer is the latter, avoid it if at all possible. Now let's discuss how to escape debt strategically if you're already carrying it. 2 primary methods exist, each with different psychological and mathematical advantages. The debt avalanche method prioritizes mathematical efficiency. You list all your debts by interest rate, from highest to lowest. You make minimum payments on everything, then put every extra dollar toward the debt with the highest interest rate. Once that's eliminated, you move to the next highest rate. This method saves you the most money in interest over time. The debt snowball method prioritizes psychological momentum and quick wins. You list all debts by balance size, from smallest to largest, ignoring interest rates. You make minimum payments on everything, then put extra money toward the smallest balance. Once that's paid off, you move to the next smallest. This method costs slightly more in total interest, but provides faster psychological victories. You see debts disappearing quickly, which creates motivation to keep going. Which approach is superior? Mathematically, avalanche wins every time. But humans aren't purely mathematical beings. We're emotional creatures who need motivation to sustain difficult changes over time. If paying off a small debt quickly keeps you motivated and prevents you from giving up entirely, snowball is better for you. If you can stay motivated by knowing you're optimizing mathematically, avalanche is better. Choose based on your personality and what you know about how you stay motivated. Either method works if you stick with it consistently. Neither method works if you quit halfway through. Beyond the method, several principles apply to debt repayment regardless of approach. Stop accumulating new debt while paying off existing debt. This sounds obvious, but many people keep using credit cards while trying to pay them down. You cannot bail water out of a boat effectively while someone's still pouring water in. Find extra money to accelerate repayment. Cut expenses temporarily. Take on a side job. Sell things you don't need. Every extra dollar toward debt shortens your timeline and reduces total interest paid. Consider balance transfers or refinancing if you can get better rates. Moving high-interest credit card debt to a 0% balance transfer card saves you interest during the promotional period. Refinancing student loans from 8% to 4% cuts your interest cost in half. Just be cautious about fees and terms. Understand that paying minimums only keeps you in debt for years or even decades. Credit card companies design minimum payments to maximize their profit, not to help you get out of debt quickly. On a $5,000 balance at 18% interest, paying only the minimum payment of $100 monthly takes over 7 years and costs over $3,000 in interest. Paying $200 monthly cuts that to under 3 years and under $1,000 in interest. The difference is massive. Now let's shift to talking about credit scores, because understanding how they work gives you power over a number that significantly impacts your financial life. Your credit score is essentially a grade that lenders use to evaluate how risky you are as a borrower. Higher scores mean lenders see you as less risky, which translates into better interest rates, higher credit limits, and easier approval for loans. Lower scores mean you're seen as riskier, resulting in worse rates, lower limits, or outright denials. Credit scores typically range from 300 to 850. Anything above 740 is generally considered excellent. 700 to 739 is good. 670 to 699 is fair. Below 670 is poor. Your score is calculated based on 5 main factors with different weights. Payment history represents 35% of your score, making it the most important single factor. Do you pay your bills on time consistently? Even one late payment can damage your score, and the damage is worse the more recent the late payment. Amounts owed represents 30%. This looks at your credit utilization ratio, meaning how much of your available credit you're actually using. If you have $10,000 in total credit limits and you're using $3,000, your utilization is 30%. Lower is better. Keeping utilization under 30% is good. Under 10% is even better. Length of credit history represents 15%. How long have you had credit accounts open? Longer history is better because it provides more data about your reliability. This is why closing old credit cards can sometimes hurt your score. You're shortening your average account age. Credit mix represents 10%. Do you have experience managing different types of credit? Mortgages, car loans, credit cards, student loans. Having a mix demonstrates you can handle various kinds of debt responsibly. New credit inquiries represent 10%. When you apply for new credit, lenders make a hard inquiry on your credit report. Too many hard inquiries in a short period suggests you're desperate for credit, which lowers your score temporarily. Improving your credit score, or maintaining an excellent score, follows a few straightforward principles. Pay every bill on time, every single time. Set up automatic payments if you need to. This single habit matters more than anything else. Keep your credit utilization low. If you're using a high percentage of your available credit, either pay down balances or request credit limit increases to lower the ratio. Don't close old credit cards unless they have annual fees you can't justify. Keep them open with small occasional purchases to maintain the account age and available credit. Don't apply for new credit unnecessarily. Each application creates a hard inquiry. Only apply when you actually need the credit and have a strong chance of approval. Check your credit reports annually for errors. You're entitled to free reports from all 3 bureaus annually. Mistakes happen, and they can damage your score unfairly. Dispute any errors you find. Building credit from scratch takes time, but it's achievable. If you have no credit history, consider a secured credit card. You put down a deposit that becomes your credit limit, use the card for small purchases, and pay it off completely every month. After 6 to 12 months of responsible use, you'll have enough history to qualify for a regular credit card. Becoming an authorized user on someone else's credit card can also help. If a parent or trusted person adds you to their account, their payment history can boost your score. Just ensure they have excellent payment history, or it could hurt you instead. Student credit cards or credit builder loans are other options for establishing initial credit history. The key is starting somewhere and being absolutely consistent with payments. Let's talk about savings now, specifically emergency funds. This is where many people's financial plans completely fall apart because life happens. An emergency fund is money set aside specifically for unexpected expenses or income disruptions. It's not for vacations or holiday shopping or buying things you want. It's for genuine emergencies. Job loss, medical emergencies, major car repairs, urgent home repairs. Why is this so critical? Because without an emergency fund, unexpected expenses force you into debt. Your car breaks down, you have no savings, so you put the repair on a credit card at 20% interest. Now you're paying interest on an emergency while trying to pay it off. With an emergency fund, you pay cash for the repair. No debt created, no interest paid, and you refill the fund over time. How much should you save? The standard recommendation is 3 to 6 months of essential expenses, not 3 to 6 months of income. Calculate your actual necessary monthly spending. Rent, utilities, groceries, insurance, minimum debt payments, essential transportation. Multiply that by 3 for a minimum emergency fund, 6 for a more comfortable cushion. If your essential monthly expenses are $3,000, you need $9,000 to $18,000 in your emergency fund. That sounds like a lot, and it is. Don't let that discourage you from starting. If you have nothing saved, your first goal is $1,000. That covers many common emergencies and prevents you from reaching for credit cards immediately. From there, build toward 1 month of expenses, then 3, then 6. Some people need larger emergency funds than others. If you're self-employed with variable income, lean towards 6 months or even more. If you have a stable job, good disability insurance, and dual incomes in your household, 3 months might be sufficient. Where should you keep an emergency fund? It needs to be liquid, meaning easily accessible without penalties. It needs to be safe, meaning not invested in the stock market where it could drop in value right when you need it. A high-yield savings account is ideal. These are savings accounts, typically at online banks, that pay significantly more interest than traditional banks. While traditional banks might pay 0.01%, high-yield accounts currently pay around 4 to 5%. It's still a savings account, fully liquid and safe, just with better returns. Don't keep your emergency fund in checking, where it's too easy to spend accidentally. Don't keep it in cash at home, where it's not earning anything and could be stolen. Don't invest it in stocks, where you might need to sell at a loss during a market downturn. A dedicated high-yield savings account kept separate from your daily banking creates the right balance of accessibility and separation. Once you have your emergency fund established, you can start focusing on investing for long-term growth. This is where actual wealth building happens. Saving is important and necessary, but saving alone won't make you wealthy. Inflation eats away at the purchasing power of cash over time. If inflation averages 3% annually and your savings account earns 1%, you're losing 2% of purchasing power every year.
Investing allows your money to grow faster than inflation, building real wealth over decades. The single most powerful force in investing is compound growth. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said that or not, the principle is profound. Compound growth means earning returns on your returns. Year 1, you invest $10,000 and earn 8%, so you end with $10,800. Year 2, you earn 8% not just on your original $10,000, but on the full $10,800. That's $864 instead of $800. The growth accelerates over time. After 30 years at 8% annually, that initial $10,000 becomes over $100,000. You contributed $10,000. Compound growth contributed $90,000. Time is the critical ingredient. The earlier you start investing, the more time compound growth has to work. Someone who invests $5,000 annually from age 25 to 35, then stops, ends up with more at age 65 than someone who invests $5,000 annually from age 35 to 65. The first person invested $50,000 total. The second person invested $150,000. The first person still ends up with more because they had an extra 10 years of compound growth. This is why starting early matters enormously. Even small amounts, given enough time, become substantial. Where should you actually invest? For most people, the answer is simple. Low-cost index funds in tax-advantaged retirement accounts. Let me break that down into pieces. Index funds are investment funds that track a specific market index. An S&P 500 index fund owns all 500 companies in the S&P 500 index in the same proportions. You're buying a tiny piece of 500 major companies with one purchase. A total stock market index fund owns essentially every publicly traded company in the US. An international index fund owns companies across developed and emerging markets globally. Index funds provide instant diversification. Instead of betting on individual companies, you're betting on the entire market. Historically, the US stock market has averaged around 10% annual returns over very long periods. Some years are up 30%. Some years are down 20%. Over decades, it averages out to around 10%. Index funds are passively managed, meaning they just track the index automatically. This keeps costs extremely low. Expense ratios, the annual fee charged by the fund, are often under 0.1% for index funds. Actively managed funds, where managers try to beat the market by picking specific stocks, charge much higher fees, often 1% or more annually. Research consistently shows that most active managers fail to beat index funds over long periods, especially after accounting for their higher fees. So you're paying more for worse results. For the vast majority of investors, low-cost index funds are the smartest choice. You get diversification, low costs, and market-matching returns. Tax-advantaged accounts are specifically designed to help you save for retirement with special tax benefits. The most common types are 401k plans, traditional IRAs, and Roth IRAs. A 401k is an employer-sponsored retirement plan.
You contribute money directly from your paycheck before taxes are taken out. That money grows tax-free inside the account. You only pay taxes when you withdraw in retirement. Many employers offer matching contributions. If you contribute 4% of your salary, they might match with another 3%. That's free money. Always contribute at least enough to get the full match. It's an instant 100% return. The contribution limit for 401k plans changes annually. For 2024, it's $23,000 if you're under 50. If your employer offers a 401k, this should be your first investment priority after getting the employer match. Traditional IR. As works similarly to 401k plans. You contribute pre-tax money, it grows tax-free, you pay taxes on withdrawal. Anyone with earned income can open an IRA at most brokerages. The contribution limit is much lower than 401k plans, $7,000 for 2024 if you're under 50. Roth IRAs work differently, but are incredibly valuable. You contribute money after paying taxes on it. That money grows completely tax-free, and you pay zero taxes on withdrawal in retirement. You've already paid taxes going in, so everything coming out is yours to keep. Roth IRAs have income limits. If you earn too much, you can't contribute directly, though there are workarounds. For most people, the ideal strategy is contributing to your 401k up to the employer match, then maxing out a Roth IRA, then going back to max out your 401k if you still have money to invest. This gives you tax diversification. Some money taxed now in the Roth, some money taxed later from the 401k. Health savings accounts, or HSAs, are another powerful tax-advantaged option if you have a high-deductible health plan. Contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are tax-free. It's triple tax-advantaged. You can invest HSA money just like retirement accounts, and after age 65, you can withdraw for any purpose and just pay regular income tax, like a traditional IRA. HSAs are often called the secret retirement account. What should you actually invest in within these accounts? For most people, a simple 3-fund portfolio covers everything you need. A total U.S. stock market index fund for U.S. company exposure. An international stock market index fund for global diversification. A bond index fund for stability and lower volatility. The exact allocation depends on your age and risk tolerance. When you're young, with decades until retirement, you can handle more volatility because you have time to recover from market downturns. A common allocation for someone in their 20s or 30s might be 70% US stocks, 20% international stocks, 10% bonds. As you get closer to retirement, you gradually shift toward more bonds and fewer stocks because you have less time to recover from potential crashes. Someone in their 60s might be 40% stocks and 60% bonds. The general guideline is your bond allocation should roughly equal your age. At age 30, 30% bonds. At age 60, 60% bonds. This is just a starting point. You can adjust based on your comfort with risk. Many brokerages now offer target date retirement funds that automatically adjust this allocation as you age. If you plan to retire around 2060, you'd buy a 2060 target date fund. It starts aggressive with mostly stocks, then gradually becomes more conservative as 2060 approaches. This is a great hands-off option for people who don't want to manage allocations themselves. The most important investing principle is consistency. Markets go up and down constantly. You will experience downturns where your account balance drops significantly. This is normal and expected. The worst thing you can do is panic and sell during a downturn. You lock in your losses and miss the recovery. History shows that markets always recover over long periods. Every crash, every bear market, every recession has eventually been followed by new highs. People who stayed invested through the crashes built wealth. People who sold in fear missed the recovery. Dollar cost averaging helps with this psychologically. Instead of investing a lump sum all at once, you invest smaller amounts regularly over time. Every paycheck, you invest $500 automatically. When markets are high, your 500 buys fewer shares. When markets are low, your 500 buys more shares. Over time, you average out the price you pay. This removes emotion from the equation. You're not trying to time the market or decide if now is a good time to invest. You just invest consistently, regardless of what markets are doing. Automation makes this effortless. Set up automatic contributions from your paycheck to your 401k. Set up automatic transfers from checking to your IRA on a specific day each month. You don't have to think about it or make decisions. It just happens. This is the system that builds wealth. Contribute consistently. Invest in diversified low-cost index funds. Don't panic during downturns. Give it decades to compound. It's not exciting, it's not complicated, but it works. Now let's address some major purchases that can derail your finances if mishandled. Starting with vehicles. Transportation is necessary for most people, but how you acquire that transportation makes an enormous difference in your financial trajectory. The average new car payment in America is over $700 monthly for nearly 6 years. That's over $50,000 total. For a depreciating asset that loses value the moment you drive it off the lot. Cars are tools for getting from point A to point B. They're not investments. They don't appreciate. Every dollar you overspend on a vehicle is a dollar not building your wealth. The financially optimal choice is buying a reliable, used car with cash. Let someone else absorb the initial depreciation. A 3-year-old car with 40,000 miles might cost half what it cost new, but it still has many years of reliable service left. Buying with cash means no monthly payments, no interest charges, full ownership immediately. I understand that's not realistic for everyone. If you need financing, follow these principles to minimize damage. Put down at least 20% to avoid being underwater immediately. Being underwater means owing more than the car is worth. With zero down, you're underwater from day one because the car depreciates faster than you pay down the loan. Keep the loan term short. Longer terms mean lower payments but much more interest paid and more time being underwater. A 4-year loan is better than 6. 3 years is better than 4. Never exceed the useful life of the car with your loan term. Don't finance a used car with 100,000 miles for 6 years. You'll be making payments on a dead car. Shop for financing before you go to the dealership. Get pre-approved through your bank or credit union. Dealership financing is often more expensive, and having outside financing gives you negotiating power. Focus on the total price of the vehicle, not the monthly payment. Dealers manipulate monthly payments by extending loan terms. A car that costs $30,000 at 5 years might become affordable monthly at 7 years, but you're paying far more in total. Negotiate the purchase price first. Once you've settled on a price, then discuss financing and trade-ins separately. Bundling everything together obscures where you're getting a bad deal. Consider total cost of ownership, not just purchase price. Some cars are cheap to buy, but expensive to maintain, insure, and fuel. Research reliability ratings, typical repair costs, insurance costs, and fuel economy before purchasing. A car that costs $5,000 less but needs $3,000 in repairs annually isn't actually cheaper. Avoid new car purchases unless you're in an excellent financial position. That new car smell costs tens of thousands in depreciation. If you absolutely insist on new, keep it for at least 10 years to spread the depreciation over maximum time. Better yet, buy certified pre-owned. These are recent used cars that have been inspected and come with warranties. You get nearly new condition at a significant discount. The worst financial decision you can make with vehicles is leasing. Leasing is renting a car long-term. You make payments for 2 or 3 years, then return the car with nothing to show for it. The payments never end because you always need another car. You're paying for the most expensive years of depreciation repeatedly. Leasing only makes sense in very specific business situations where you need to minimize tax liability. For personal use, it's almost always a poor choice. Now let's talk about housing. Specifically, the rent versus buy decision. This is one of the most significant financial decisions you'll make, and there's no universal right answer. It depends entirely on your situation, market, timeline, and goals. The cultural message in America is that home ownership is part of the American dream, that renting is throwing money away, that you should buy as soon as possible. This is overly simplistic and leads many people to buy when renting would serve them better. Buying makes sense when several conditions align. You plan to stay in the area for at least 5 to 7 years. Buying and selling homes involves significant transaction costs. Realtor commissions, closing costs, moving expenses, these can total 10% or more of the home's value. If you buy and sell quickly, these costs eat any potential appreciation. You need time for appreciation to offset transaction costs. You have a stable income and emergency fund. Home ownership comes with unexpected expenses. Roofs leak, furnaces die, pipes burst. If you're living paycheck to paycheck, these emergencies become crises. You need financial stability before taking on a mortgage. The local market has reasonable price-to-rent ratios. In some markets, buying costs roughly the same monthly as renting a comparable property. In others, buying costs twice as much. If buying is dramatically more expensive, renting might be smarter financially. You want the stability and control that ownership provides. Fixed housing costs, ability to modify your space, building equity. These have value beyond pure financial calculations. Renting makes sense in different situations. You value flexibility and might move for jobs or personal reasons. Renting allows you to relocate with minimal hassle and cost. You're in an expensive market where buying would stretch your budget dangerously. In cities like San Francisco or New York, buying often requires enormous down payments and mortgage payments that consume half your income. Renting lets you live in these cities without financial ruin. You prefer to invest your money elsewhere. The down payment and ongoing costs of ownership could instead be invested in the market, potentially providing better returns. You don't want the responsibilities of maintenance and repairs. Home ownership requires time, money, and effort for upkeep. Renting transfers those responsibilities to the landlord. Let's do the math on a realistic scenario. Imagine a home costs $400,000. You put 20% down, so $80,000. You take a $320,000 mortgage at 7% for 30 years. Your monthly mortgage payment is about $2,130. Add property taxes at 1.2% annually. That's $400 monthly. Add homeowners insurance at $1,000 annually, that's $83 monthly.
Add maintenance at 1% of home value annually. That's $333 monthly. Your total monthly cost is approximately $2,946. A comparable rental might cost $2,200 monthly. On the surface, buying costs $746 more monthly. But you're building equity through mortgage payments. About $670 of that first mortgage payment goes toward principal. You also get tax benefits if you itemize deductions. Mortgage interest and property taxes can be deducted. After several years, if the home appreciates, you could sell for a profit. If you rent instead and invest the difference, you pay $2,200 in rent. You invest the down payment of $80,000 in index funds. You invest the $746 monthly difference in index funds. After 7 years, assuming 8% investment returns, you'd have about $220,000 in investments. If the home appreciated at 3% annually, it would be worth about $493,000. You'd owe about $289,000 on the mortgage. Your equity would be $204,000. The renter has more liquid wealth. The homeowner has more total wealth, but it's illiquid and requires selling the home to access. This is massively simplified and ignores many factors, but it illustrates that buying isn't always obviously superior. It depends on appreciation rates, investment returns, tax situations, and how long you stay. The point is not that renting is always better or buying is always better. The point is to run the actual numbers for your situation instead of accepting the cultural narrative that buying is always smart. If you do decide to buy, follow these guidelines to avoid financial disaster. Don't buy more house than you need. Housing costs should not exceed 28% of your gross income. If you earn $100,000 annually, your housing costs, including mortgage, taxes, insurance, and maintenance, should not exceed $2,300 monthly. Lenders might approve you for more, but that doesn't mean you should borrow it. Save at least 20% for a down payment. This avoids PMI, private mortgage insurance, which protects the lender if you default. PMI can cost hundreds monthly and provides you zero benefit. 20% down also gives you immediate equity and better interest rates. Get a 15-year mortgage if you can afford the payments. You'll pay dramatically less interest over the life of the loan. A $300,000 mortgage at 7% costs about $277,000 in interest over 30 years. The same mortgage at 15 years costs only $142,000 in interest. You save $135,000. The monthly payment is higher, but if you can afford it, it's worth it. If you can't, 30 years is fine. Just pay extra when possible. Have your home inspected thoroughly before purchasing. Spend a few $100s on a quality inspector who will find problems before they become your problems. Budget for maintenance and repairs from day one. The 1% rule is a good guideline. A $400,000 home should have $4,000 annually budgeted for maintenance. Some years you'll spend less. Some years you'll spend more. Average it out. Now let's talk about insurance, because proper insurance protects everything you've built. Insurance is essentially paying someone else to absorb catastrophic financial risks you cannot afford to take yourself. You pay premiums regularly. In exchange, if disaster strikes, the insurance company pays the claim. For large enough potential losses, this trade makes perfect sense. For small potential losses, it usually doesn't.
Health insurance is absolutely non-negotiable. Medical costs in America can bankrupt you. A single serious illness or injury can generate hundreds of thousands in bills. Always have health insurance. If your employer offers it, take it. If not, purchase it through the healthcare marketplace. Compare plans based on premiums, deductibles, out-of-pocket maximums, and provider networks. Higher premiums usually mean lower deductibles and out-of-pocket costs. Lower premiums mean higher deductibles. Choose based on your health, savings, and risk tolerance. If you're healthy with a solid emergency fund, a high-deductible plan with lower premiums might be smart. If you have chronic conditions requiring regular care, a low-deductible plan saves money despite higher premiums. Auto insurance is legally required in most states and financially necessary everywhere. Liability coverage pays for damage you cause to others. This should be high enough to protect your assets. If you have significant net worth, carry high liability limits. Collision coverage pays to repair your car after an accident. Comprehensive coverage pays for theft, vandalism, weather damage. If your car is old and not worth much, you might skip these and just carry liability. If your car is valuable or financed, you need full coverage. Homeowners or renters insurance protects your dwelling and possessions. Homeowners insurance is required by mortgage lenders and wise even if not required. It covers rebuilding if your house burns down, repairs if a tree falls on it, liability if someone is injured on your property. Renters insurance is cheap, often $15 to $30 monthly, and covers your possessions if they're stolen, damaged by fire, and so on. It also includes liability coverage if someone gets injured in your home. Life insurance is important if anyone depends on your income financially. If you die, life insurance provides money to your dependents. The simplest and most cost-effective type is term life insurance. You pay for coverage for a specific period, 10, 20, 30 years. If you die during that period, your beneficiaries receive the death benefit. How much coverage depends on how much income you're replacing and for how long. Disability insurance is often overlooked but critical. It replaces a portion of your income if you become unable to work due to illness or injury. Your ability to earn is your greatest asset, especially early in your career. Check if your employer offers disability coverage. If not, consider purchasing a private policy. The general principle with insurance is to protect against catastrophic losses you couldn't absorb yourself. Don't insure small losses you could cover on your own. Extended warranties on electronics, for example, are usually poor value. The point is preventing financial ruin, not avoiding every possible expense. Now a word on scams and protecting yourself from fraud. Financial scams cost billions of dollars annually. They're becoming increasingly sophisticated, especially with AI technology enabling more convincing fake communications. The best defense is awareness and healthy skepticism. If something seems too good to be true, it absolutely is. Guaranteed returns of 20% annually, that's a scam. Secret investment opportunity that requires immediate action, definitely a scam. Nigerian prince with millions to share, obviously a scam, but people still fall for variations. Never give out personal information like social security numbers, bank account numbers, or passwords to anyone who contacts you unexpectedly. If your bank calls asking for information, hang up and call the number on your card. Legitimate organizations never ask for sensitive information through unexpected calls or emails. Be wary of pressure tactics and artificial urgency. Scammers want you to act before you think clearly. Any legitimate opportunity will still exist after you've had time to research and consider carefully. If someone is pushing you to decide immediately, that's a major red flag. Protect your accounts with strong, unique passwords and enable two-factor authentication wherever possible. Monitor your credit reports for accounts you didn't open. Freeze your credit if you're not planning to apply for new credit soon. This prevents anyone from opening accounts in your name. The emotional component matters here. Scammers exploit fear, greed, and urgency deliberately. They catch you when you're vulnerable. The best protection is developing a habit of pausing before acting on any financial communication that triggers strong emotions. Sleep on it. Talk to someone you trust. Research thoroughly before you send money or share information. Finally, let's talk briefly about taxes. Taxes are an enormous topic that varies dramatically by individual situation, and I won't pretend to cover everything here comprehensively, but a few principles matter for everyone. Understand your marginal tax rate. This is the rate you pay on your last dollar of income earned. If you're in the 24% tax bracket, reducing your taxable income by $1 saves you 24 cents. This is why tax-advantaged accounts like 401k plans and traditional IRAs are so valuable. Contributions reduce your taxable income today. Use tax-advantaged accounts first before investing in taxable accounts. Before putting money into a regular brokerage account, max out your 401k match, your IRA, and possibly an HSA if you're eligible. These accounts shelter your money from taxes in various beneficial ways, accelerating your growth. Don't let taxes drive decisions entirely, though. Sometimes people avoid selling investments because of capital gains taxes, even when selling would be the smart move strategically. Don't hold on to a bad investment just to avoid paying taxes. The tax on gains is only a portion of the gains. You still come out ahead financially. Keep good records of everything. Track what you contribute, what you earn, what you can potentially deduct. Good, organized records make tax time easier and prevent costly mistakes. Consider professional help if your situation is complex. A good accountant or tax preparer can catch deductions you'd miss and ensure you're fully compliant. The cost often pays for itself in tax savings. We've covered substantial ground together. The snapshot of where you stand financially, the mechanics of debt and credit scores, the importance of goals and budgeting, the power of compound growth through disciplined investing, the major purchases that can make or break your finances, the protections you need against risk and fraud. But knowledge without action is just entertainment. The question now is, what will you actually do with this information? Here's a suggested path forward you can follow. This week, calculate your net worth accurately. Add up all your assets. Subtract all your liabilities. Know the number. This week, track your income and expenses carefully. Use an app, use spreadsheets, use whatever works for you. Get clear on where your money actually goes. This month, set up automatic transfers to a high-yield savings account. Start building or reinforcing your emergency fund systematically. This month, if you have an employer-sponsored retirement account, confirm you're contributing at least enough to get the full employer match. Increase your contribution percentage if you can. This quarter, list all your debts with current balances and interest rates. Choose avalanche or snowball method. Make a plan. Start executing immediately. This year, set specific financial goals with realistic timelines. Calculate what you need to save and invest monthly to reach them. Automate those contributions. Ongoing, review your finances quarterly. Are you on track? What needs adjusting? Keep learning. Keep improving your knowledge. The gap between financial literacy and financial success is action. Knowing this information puts you ahead of most Americans already. Implementing it consistently changes your entire life. Remember the numbers from the beginning. The average American loses nearly $1,000 per year to financial illiteracy. That compounds into hundreds of thousands over a lifetime. You've just invested an hour into closing that gap. The return on this investment, if you actually act on it, will be enormous. The people who build wealth aren't necessarily smarter or luckier than others. They're more intentional. They understand the rules of the game. They build systems that work in their favor. They make conscious choices rather than drifting on defaults. You now understand the rules. You have the framework for building the systems. You know what conscious financial choices look like. The ground doesn't have to crumble beneath your feet, but you have to stop walking toward the cracks. If you're just starting out, you have time on your side. Use it wisely. Even small amounts compound into significant sums over decades. If you're further along and feel behind, you still have time, just less of it. Be more aggressive. Cut what doesn't serve your goals. Maximize your tax-advantaged contributions. Prioritize building wealth over displaying lifestyle. The traps are real. The system often works against you. The education you needed was never provided properly, but now you know. And knowledge combined with action is the path out. You've made it to the end. That already separates you from most people. Take what you've learned and build the financial life you deserve. The simple path to wealth is this: spend less than you earn. Invest the surplus wisely. Avoid debt that doesn't serve you. Let time do the heavy lifting. It's straightforward. It works. And now you know how.